A very good day to Dr. Emma and my dear friends. My name is Shamili Tyagarajan and I'm here today to discuss on the global financial crisis of 2008. What is the global financial crisis of 2008? Financial crises are major disruption in financial markets characterized by sharp declines in asset prices and firm failures. In the United States, beginning in August 2017, defaults in the subprime mortgage market sent a shudder through the financial markets, leading to the worst financial crisis since the Great Depression. In congressional testimony, Alan Greenspan, former chairman of the Fed, described the financial crisis as a once-in-a-century credit tsunami. Wall Street firms and commercial banks suffered hundreds of billions of dollars of losses. Households and businesses found they had to pay higher rates on their borrowings, and it was much harder to get credit. All over the world, stock markets crashed, with the US market falling by over 50% from its peak. Many financial firms, including commercial banks, investment banks, and insurance companies, went belly up. A recession began in December of 2007, and by the fall of 2008, the economy was in a tailspin. The recession, which ended in June of 2009, was the most severe since the World War II and is now known as the Great Recession. Let's take a look at a brief explanation at the global financial crisis of 2008 by my team members Tae-Jin Hwan, followed by Choi Jin Feng, Yeo Nichi, and Yan Yu Yu.
Good day, my name is Tae-Jin Shen. I would like to discuss how did the 2008 financial crisis happen. The 2008 financial crisis is also called subprime mortgage crisis, a contraction of liquidity in the global financial markets that started from the collapse of the housing markets in the United States. First, the crisis happens because of the significant reduce in the federal funds rates in the United States in a short period of time from 6.5% in May 2000 to only 1.75% in December 2001. The significant decrease in the federal funds rate indirectly increased the borrower's credit in borrowing loans and encouraged the banks to lend even more loans to the high default risk customers, or so-called subprime. However, these conditions gave chance to speculators using the easy loans in trading houses and resulted in the creation of a housing bubble. Secondly, the banks market their subprime loans aggressively to their customers with low credit ratings. Although the banks knew that the subprime borrowers were not capable to pay back the loans, they still misled them to involve in the risk. The banks could repost the houses or resold them at a market price which they believed to be higher. As a result, the percentage of the subprime loans increased nearly 15% per year in 2000. This seeded a huge potential risk of default in the banks as the house's price fell in the 2007 and 2008. Third, the banks sold many of the mortgage-backed securities to the other banks, investment companies, or even hedge funds. MBS were bundled with hundreds of thousands of subprime mortgages. The MBS with high percentage of subprime mortgages had more people exposed to the risk of suffering losses, as the drastic increase in housing prices were not based on their intrinsic value. Fourth, the Securities and Exchange Commissions of the United States have weakened the net capital requirement that act as the safeguards against insolvency. This encouraged banks to invest even more money into MBS, but exposed the bank's portfolio to significant risk. Since banks play a very important role in the financial markets, they were too big to fail. Their failure will then damage the whole financial market system. Therefore, the low federal fund rates that lead to more subprime loans, which then lead to the increase of high default risk MBS, and weakened safeguards were the causes of the 2008 financial crisis when the housing bubble burst. That's all for my presentation. And now I'll pass the presentations for the next presenter. Thank you.
A very good day to my respective lecturer, Dr. Emma. My name is Choi Jin Feng and my metric number is 149858. Today, I would like to present about what are the consequences of the 2008 financial crisis on the United States market. The first consequence is deregulation in the financial industry. Deregulation in the financial industry was the primary cause of the 2008 financial crash. It allows speculation on derivatives backed by cheap, wantonly issued mortgage available to even those with questionable creditworthiness. Next, the second consequence is rising property value and easy mortgage. Rising property value and easy mortgage will attract a lot of people to avail of home loan. This creates the housing market bubble. When the Federal raised interest rate in 2004, the consequential increased mortgage payments squeezed home borrower abilities to pay. This burst the bubble in 2008. Besides, the third consequence is the intermediately tie of home loan. Since home loans were intermediate tied to hedge funds, derivatives, and credit default swaps, the resulting crash in the housing industry drove the U.S. financial industry to its knees as well. With its global reach, the U.S. banking industry almost pushed most of the world financial system to near collapse as well. The fourth consequence is the aftermath of the 2008 crisis. The aftermath of 2008 crisis saw plenty of hardship. There are millions of Americans lost their home to mortgage foreclosures. And by the summer of 2010, the jobless rate had risen to almost 10%. But noting of comparable scale, today the employment rate has fallen all the way to 3.9%. The next consequence is the stock market crash. The stock market crash of 2008 was a result of default on consolidated mortgage-backed securities. Subprime housing loans comprise most MBS. Banks offer this loan to almost everyone, even those who were not creditworthy. Lastly, is the dropping of house market fell. When the housing market fell, many homeowners default on their loan. This default resound all over the financial industry, which heavily invested in MBS. Consequently, companies doing business with this bank were negatively affected, and this pummeled their stock in turn. That's all for me. Thank you.
A very good day to Dr. Emma. My name is Yao Niji and my metric number is 147787. I'm going to discuss how did the 2008 financial crisis affect the financial market in Malaysia. During the 2008 financial crisis, Malaysia's economy has suffered a significant impact and worsened in the fourth quarter of 2008. Such a situation can be shown in the contraction of Malaysian GDP from negative 2.3% in the first quarter to negative 8.4% in the fourth quarter. First of all, the occurrence of the financial crisis has influenced the capital flows in Malaysia. This is because the banks and other financial institutions in the United States have reduced their trading volume with other countries. Hence, the capital flows flowing from United States into Malaysia has fallen from negative 37.7 ringgit billion in 2007 to negative 118.5 ringgit billion in 2008. The crisis also prompted a drop in portfolio flows. In 2008, the investment portfolio in Malaysia recorded the largest net outflow of 84.4 ringgit billion, compared to a net inflow of 18.4 ringgit billion in 2007, which had implied the capital outflow from Malaysian bonds and stocks market. Besides that, to prevent an economic collapse, US Federal Reserve took an aggressive action by dropping its target Fed fund rate to the range between 0 and 0.25% in 2008. In response to this change, Bank Negara Malaysia had announced to lower the overnight policy rate to 3.25% and further cut it to 2.5% in 2009. Consequently, the value of ringgit suffered a loss of about 6% against the US dollar, which is from 10.6% in 2007 to 4.5% in 2008. The uncertainty in the global financial market caused banks in Malaysia reduce their supply of credit due to the weaker financial condition and the decline in customers' creditworthiness. As a result, the global financial crisis since 2008 has hit Malaysia hard, mainly through financial and trade sector. That's all for me. Thank you.
Hi everyone, my name is Ye Yuyin. Now I will introduce when the economy started to rebound in Malaysia after the 2008 financial crisis and what were the strategies taken. The impact of the world financial crisis on Malaysia. The U.S. subcredit crisis in September 2008 evolved into a financial crisis and quickly spread to developed, emerging, and developing countries. Malaysia has close trade relations with the U.S. and Europe. The U.S. financial crisis will inevitably affect Malaysian national economy. Under the impact of the global financial crisis, since Malaysia is a country that relies heavily on export and foreign investment, the Malaysian economy has begun to decline since the fourth quarter of 2008. The global financial crisis had dealt a serious economic blow to Malaysia. The Malaysian government has also adopted a proactive fiscal policy and loosening monetary policy, which are the most important measures to deal with the global financial crisis. For the monetary policy after 2008, Malaysia used the currency expansion to respond to the global crisis. Due to the low inflation rate in Malaysia, the balance of payments is sound, and the economic environment is healthy. By cutting interest rates, the domestic economy has been stabilized and the domestic economy has been better developed. Malaysia has lowered the statutory reserve ratio of bank from 4% in 2008 to 1% in March 2009 in the following year. For the fiscal policy, the Malaysian government increased the fiscal expenditure to stimulate the economy, directly inject large amounts of the funds, which reached 67 billion ringgit in fiscal policy to encourage domestic consumption and support the country's economic development. Malaysia has increased the related constructions of public facilities and service, strengthened public implementation, the construction and upgrading of industrial infrastructure. Malaysia also pay attention to education, medical facilities, and people's housing issues to restore and develop the economy. Malaysia is still working hard to promote the development of the service industry and increase the development of tourism, health and transportation, open more areas of the service industry to attract foreign investment and promote foreign investment to develop Malaysian economy. Finally, through a series of policy in the second half of the 2009 and the first half of the 2010, we can know that the Malaysian economy has developed well and rebounded rapidly. Malaysia's export trade has also shifted from relying on the U.S. to gradually turn to other countries, and the trade export with other countries has risen after global financial crisis.
As a conclusion, in the wake of the global financial crisis that led to a severe drop in international trade, the rise in unemployment levels and the slump in commodity prices left no country immune from the ripple effects of the credit crunch. Governments of different countries carry out short-term emergency plans to rescue their respective economics and put in place long-term policies to reform their entire financial system. For most governments, the immediate short-term response to the global recession was to draw up emergency plans to avoid deflationary spirals, that is to stop lower prices from causing ever-decreasing demand and output. In addition to the expansionary monetary policy, bailout plans were extended and stimulus packages were provided. In order to save the financial sector and to avoid contagion, financial support was provided by many governments to bail out banks, other financial institutions, and even the so-called too big to fail firms that were severely affected by the financial crisis. Generally speaking, to boost their individual economies, most governments use fiscal stimulus packages that combine government expenditure and tax cuts. Next, stabilizing the global financial system is through long-term responses. In addition to the individual emergency national bailout packages extended to rescue national economics and financial sectors, global leaders simultaneously rushed to build a more stable and robust global financial system. First, the Global Financial Regulatory Framework, which is the construction of a global financial framework that is resilient to shock, requires reducing the hazardous effect of financial instruments and re-engineering of financial institution risk-taking activities. This involves a combination of national and global strategies. Furthermore, policy areas at the national level, such as the first of many national level policy areas is a sound monetary policy, the second area, fiscal policy, and the third area of national polity concerns the strengthening of the financial infrastructure. The fourth national policy area is consumer protection. In order to prevent future crises and to achieve global financial stability, a large globally overhauled and comprehensive supervisory system is imminent. Global regulators are taking slow yet steady steps such as bilateral and multilateral supervisory cooperation, collective supervisory cooperation, collectively coordinated macroeconomic stability plans, and self-discipline towards enhancing global cooperation and coordination. These efforts have so far ranged from bilateral and multilateral cooperation all the way to collective initiative. That's all from us. Thank you.